It is December 24th, Christmas Eve. Across the Western world, people are wrapping gifts, pouring drinks, and assuming the year's ending quietly. Wall Street is technically open for a half day, but the trading floors are empty. Liquidity is supposed to be dead. Nothing important is supposed to happen today. And that assumption is exactly why what happened next is so dangerous. Because while the West was distracted, the East didn't just move the silver market, it broke it. This is not exaggeration. This is not clickbait. We are watching events that should not be possible inside a functioning financial system. Core assumptions of modern finance are failing in real time, and almost no one is paying attention. Not because it isn't important, but because it's happening on a holiday when attention is elsewhere. At 3:30 a.m. Eastern Time, the Shanghai Gold Exchange and the Shanghai Futures Exchange opened for trading. What followed in the first 30 minutes was not normal volatility. It was a rupture, the kind of price action that forces risk managers to wake up in cold sweats. This wasn't a temporary imbalance. This was a structural break. For months, we've been tracking the growing gap between East and West. We showed how physical silver was steadily leaving Western vaults, while New York continued trading paper contracts. Two markets tied together for decades, slowly pulling apart. But today, that slow drift turned into a snap. Silver closed in Shanghai at $77.89 per ounce converted into US dollars. At the same time, New York was trading near 72. Same metal, same moment. A spread this large is not a market inefficiency. It's a warning signal. It tells us the arbitrage mechanism, the glue holding global prices together, is failing. And when arbitrage breaks, nothing behaves normally again. Time compresses, volatility accelerates, and problems that once took years to surface begin to unfold in days. This is how system failures begin, quietly, on holidays, when most people aren't looking. If you want to understand what this means and where it leads, stay with me. Now let's slow this down and look at the numbers, because this is where disbelief turns into alarm. Silver in Shanghai closed at $77.89 per ounce, priced in real US dollars. Not yuan, not a theoretical conversion, actual dollars. At the exact same time, silver in New York was trading around 72. Depending on when you looked, maybe a little higher, maybe a little lower, but firmly below Shanghai. That creates a spread of roughly $5.66 per ounce. Pause on that number for a moment. In modern commodity markets, that kind of gap is not supposed to exist. Not for minutes, certainly not for hours. Since the 1980s, the entire system has been built on one assumption: identical assets converge in price through arbitrage. Under normal conditions, this gap should close almost instantly. Banks, hedge funds, algorithms, and traders would buy silver in New York, ship it east, sell it in Shanghai, and lock in risk-free profit. That's not speculation. That's mechanical. That's how global markets stay aligned. But it didn't happen. The spread didn't shrink. It held, and then it widened. That's the signal. When free money exists on Shanghai and nobody takes it, it means the trade cannot be executed. Not because traders are stupid, but because something fundamental is broken. This is where the illusion ends. The price you see on the New York screen is not the price of silver. It's the price of a promise, a paper contract, an IOU. When someone tries to turn that promise into physical metal, the system stalls. Delays appear, premiums explode, availability disappears. Shanghai is showing you the price of reality, the price of metal that exists, that can be delivered, that can be used. New York is showing you a number that assumes everything is fine. Markets don't break all at once. They fracture along their weakest link. And right now, that link is the assumption that paper and physical are the same thing. Once that belief dies, everything reprices. To understand why this spread refuses to close, you have to understand what should be happening in a functioning market, and then confront why it isn't. Under normal conditions, a $5 gap between major exchanges would trigger immediate action. Every large bank, hedge fund, and trading algorithm on the planet would rush to buy silver where it's cheap and sell it where it's expensive. No prediction, no opinion, just execution. That trade is not happening. And there is only one reason a risk-free arbitrage trade does not occur: the metal cannot be moved. When institutions attempt to buy silver in New York at $72 and convert those paper contracts into physical bars, the system breaks. What appears liquid on a screen becomes illiquid the moment delivery is requested. Delays emerge, premiums appear, quantities shrink, and eventually the answer becomes silence. This is the exact point where paper price and physical price stop pretending to be the same thing. Shanghai is bidding $77.89 because buyers there are not trading charts or contracts. They are demanding real metal. They need delivery, they need certainty, and they are willing to pay a premium to secure it. This is why arbitrage is failing. You cannot ship what does not exist in deliverable form. Once arbitrage fails, price discovery collapses. The entire global system depends on one belief that delivery is always possible if you pay the price. When that belief dies, prices stop converging and start fragmenting. This is how a market transitions from financial to physical. The question is no longer, what is silver worth? The question becomes, is there any silver left? And once scarcity takes control, price stops asking permission. When markets reach this stage, speed matters more than price. Most people obsess over where silver is trading. Experienced professionals obsess over how fast it's getting there. Velocity is the tell. It reveals whether a move is controlled speculative or fundamentally unstable. Humans are wired for linear thinking. If a market rises $10 over 10 months, we instinctively expect the next $10 to take another 10 months. That logic once kept us alive, but it collapses in broken financial systems. When markets fracture, price no longer moves in straight lines. It accelerates. Look carefully at this timeline of this rally. The move from $20 to $30 took almost 5 months. From 30 to 40, another 5 months. Slow, predictable, rational. This is what healthy bull markets look like. Plenty of time to build positions, manage risk, and stay emotionally grounded. Then the rhythm broke. From 40 to 50 took just over a month. From 50 to 60, less than 2 weeks. Time compressed by more than 70%. Sellers vanished. Resistance collapsed. Liquidity thinned. What was once a steady climb turned into vertical momentum. This is the parabolic phase. The moment when charts stop behaving like analytical tools and start behaving like warning signals. Pullbacks become shallow and violent. Volatility spikes. Confidence turns into urgency. Hesitation becomes expensive. At this stage, the market is no longer asking what silver will be worth tomorrow. It's asking whether any metal is available right now at any price. Scarcity replaces valuation. Urgency replaces patience. Parabolic moves don't end because they're expensive. They end because something breaks. Liquidity, infrastructure, trust. And right now it isn't price that's cracking. It's the system beneath it. To understand why the system is under this kind of stress, you have to look beneath the price chart and into the plumbing of the market. This is where most retail traders stop paying attention and where professionals start to panic. I'm talking about swap rates. This morning, a critical signal flashed red. The 1-year silver swap rate minus U.S. interest rates collapsed deep into negative territory. Not slightly negative, not briefly distorted. Negative by more than 7%. That number alone tells you the physical market is screaming. Under normal conditions, buying silver for delivery in the future should be cheaper than buying it today. Why? Because holding metal costs money. Storage costs, insurance costs, security costs, opportunity costs. Those expenses are built into futures pricing. This natural state is called contango, and it's how you know a commodity market is functioning. But silver is doing the opposite. The market is now paying a premium for immediate delivery. Buyers are willing to lose 7% just to get metal now instead of later. That is not speculation. That is desperation. In plain English, the market is saying this: I don't trust that silver will be available in the future. I need it today. That mindset does not come from traders chasing profits. It comes from entities that cannot afford delays. These are industrial buyers, manufacturers, supply chains, companies whose factories stop without silver. They don't care about charts. They don't care about pullbacks. They care about continuity, production, survival. Backwardation at this level is not a pricing anomaly. It's a supply shock. It means the just-in-time inventory model has failed. It means buyers are reaching directly into the system and pulling metal forward because they no longer believe tomorrow is guaranteed. This is the point where markets stop behaving like markets and start behaving like stress tests. To grasp how dangerous this moment really is, you need historical context. We have seen silver backwardation before, but never like this, and never for these reasons. The comparison most people reach for is 1980, the Hunt brothers squeeze, but that comparison is misleading. In 1980, backwardation was driven by speculation. 3 wealthy individuals used leverage to corner the futures market. It was financial pressure, not industrial necessity. And because it was leverage-driven, it could be stopped. The rules were changed. Margin requirements were raised. Liquidity was cut off. The squeeze collapsed. We saw something similar in 2011. Backwardation appeared again as retail investors piled into silver after the financial crisis. Fear of inflation, fear of currency debasement. It felt intense at the time, but it was emotional, and emotional markets can be shaken out, raise margins, smash the price, create panic, retail sells, cycle ends. Today is different. This backwardation is not coming from speculators trying to get rich. It's coming from industrial buyers and sovereign interests securing supply. These buyers are not leveraged, they are not emotional, and they cannot walk away. A solar manufacturer cannot pause production because the price dipped. An electronics firm cannot wait for a pullback when contracts must be delivered. These are price inelastic buyers. They will pay whatever is required because the cost of not having silver is higher than any premium. This is what makes the current setup exponentially more dangerous than anything in the past. You cannot scare these buyers out. You cannot change margin rules to stop them. They are not trading, they are securing survival. When a market shifts from speculative demand to mandatory demand, the rules change. Price no longer rations demand, availability does. And once a commodity enters that phase, volatility is no longer the risk. Shortages. Now put yourself inside the mind of the bullion banks, because this is where the situation turns from dangerous to existential. These institutions exist to provide liquidity. They stand between buyers and sellers, earning small spreads by ensuring the market always functions. That model only works if metal can always be sourced when needed without hesitation. Today, that assumption is failing. A bank can sell silver without holding it because it trusts the swap market. If delivery is required, it borrows metal from another bank, settles the obligation, and returns the metal later. That trust is the foundation of the system. When swap rates collapse deep into negative territory, that trust evaporates instantly. Banks stop lending to each other, not out of malice, but out of fear. Imagine a risk manager receiving a request to deliver 1 million ounces of silver next month. In normal times, this is routine. Today, it's terrifying. When they try to source that metal through the interbank market, the response is silence or refusal. Everyone is hoarding. Everyone is protecting themselves. At that moment, the bank becomes naked short. It has promised delivery without a reliable way to secure supply. If it goes to the open market to buy metal, its own buying pushes prices higher, magnifying losses across its entire book. Every option makes the problem worse. This is the doom loop. Banks that still hold physical metal pull it out of circulation. They stop lending. They stop swapping. They retreat into survival mode. Liquidity collapses not because demand disappears, but because no one is willing to part with what they have. This is how markets freeze from the inside, not with a dramatic crash, but with quiet paralysis. And when trust between institutions breaks, there is no emergency button fast enough to fix it. This is the point where the same question surfaces again and again. Won't the authorities stop this? Can't regulators intervene, halt trading, change the rules, and force the system back into order the way they have in the past? It's a reasonable question, and it reveals how deeply most people still believe the market is ultimately controllable. Yes, New York can halt futures trading. Exchanges can declare emergencies. Positions can be restricted to liquidation only. Screens can go dark. Those tools exist, and history proves they can be used. But here is the critical distinction almost everyone misses. You can halt paper. You cannot halt physical reality. If the futures market in New York shuts down tomorrow, silver does not stop being needed. Factories do not shut off their machines. Supply contracts do not disappear. Solar panels still require silver paste. Electronics still require contacts. Batteries still require metal. The real economy does not pause because a screen stops updating. Shanghai does not require permission from New York to function. The physical market continues trading because it must. Metal flows toward demand, not toward regulation. When paper markets freeze, reality simply roots around them. If futures trading is halted, backwardation does not resolve. It intensifies. Negative swap rates sink deeper. Scarcity becomes impossible to ignore. And prices in the physical market rise faster, not slower. This is how pricing authority shifts in the real world, not through press releases or emergency meetings, but through necessity. Once buyers bypass New York, the posted price loses credibility. A price without metal behind it is just a number, and numbers without trust have no power. This is not a temporary disruption. This is a regime change, and when control slips away at this level, it almost never comes back. Now we arrive at the evidence that removes all doubt, the part of the story where theory becomes physical reality. Prices can be argued with, charts can be debated, but inventory does not lie. While most people were focused on screens, the metal itself was moving. Large quantities of deliverable silver were being pulled out of Western vaults at the exact moment prices were reaching historic highs. That is the opposite of normal market behavior. When prices rise, supply is supposed to appear. Sellers are supposed to step in. Instead, silver was leaving. This is what a modern bank run looks like. Not lines outside buildings, not panic in the streets. Forklifts, armored trucks, pallets of metal quietly exiting the system. Owners of silver choosing certainty over promises, choosing possession over paper. Registered inventory, the metal officially available to settle futures contracts, has been draining at an accelerating pace. That category is the backbone of the paper market. It's what gives contracts credibility. When registered inventory falls, confidence falls with it. And this is happening at the worst possible moment for the system. Banks are short. Industrial buyers are desperate. Arbitrage is broken. Swap markets are frozen. Every ounce that leaves reduces flexibility. Every withdrawal tightens the noose. Here's the psychological shift most people underestimate. Once participants start asking for metal instead of contracts, the behavior spreads. No one wants to be last. No one wants to discover too late that delivery is no longer possible. This is how confidence collapses, quietly then suddenly. A paper market can survive volatility. It cannot survive mass conversion into physical demand, because once enough people demand reality, the illusion ends. At this stage, the market is no longer balancing supply and demand. It's revealing where the metal actually is. And it isn't where the price says it should be. So this is where we stand, and this is where clarity matters more than emotion. What we are witnessing is not a spike, not a bubble, and not a temporary dislocation. It is a structural transition, a shift from a price set by leverage and paper promises to a price set by availability and necessity. Let's summarize the lessons clearly. First, when arbitrage breaks, markets stop being global and start being local. Price no longer reflects theory. It reflects access. Whoever controls the physical supply controls the outcome. Second, when backwardation becomes extreme, it is not signaling opportunity. It is signaling stress. It tells you the system no longer trusts the future to deliver what it promises today. Third, when inventory drains during record prices, that is not profit-taking. That is fear. It is informed players choosing certainty over yield. That behavior almost never reverses quickly. For investors and traders, the mistake at moments like this is chasing headlines or timing tops. This is not about guessing the next dollar move. It is about understanding regime change. In regime shifts, volatility increases, pullbacks shorten, and narratives flip faster than most people can adapt. The smartest move is not panic. It is preparation. Reduce reliance on leverage. Understand counterparty risk. Separate paper exposure from physical reality. And above all, stop assuming that yesterday's rules still apply. Markets do not warn politely when they change character. They demonstrate it. What we are seeing now is a system repricing trust itself. If you have made it this far, you are already ahead of most participants. Stay observant, stay disciplined, and do not confuse calm screens with stable systems. If this analysis helped you see the bigger picture, take a moment to subscribe, like, and share this with someone who still believes nothing happens on holidays. Leave a comment with 1 if you want continued breakdowns like this, or 2 if you want me to stop here. The quiet moments are often the most important. And this one matters.